as I and other free banking theorists understand it. Scotland, I mentioned, that was one. Canada was another. All of these were approximate. They all involved, some departures from the ideal, but they were certainly closer than anything the United States ever had. And they all worked pretty well. They were all pretty stable, and that's what Hal is referring to when he talks about the stability of free banking. He's not just referring to my theory. There are empirical examples that testify to that stability.
So just to start off with my first question, what do you recall about Hal Finney's 2010 post and his reference to your work?
Well, I never spoke to Hal Finney. Uh, we were on a listserv together and engaged in some online back and forth, but I don't know much more about what he had in mind in that particular posting, which was later on when I wasn't directly involved, uh, other than what he says, of course. And now I can conjecture, I can speculate. I think that Hal, first of all, he says that free banking is an inflationary. I think implicitly he means free banking on a Bitcoin base, right? Because a free banking arrangement is only as non-inflationary as the monetary base regime that it is based upon. So, in principle, if you had a monetary base that expanded like mad, even with free banking, you would have inflation. But with a Bitcoin standard, free banking wouldn't be inflationary because the Bitcoin standard itself limits the amount of base money that will ever exist to something shy of 21 million coins, as you know. And the banking system will not create excessive growth of Bitcoin substitutes because that growth will be limited by the demand for such substitutes, which is what I talk about in the book that Hal refers to. So I think that's what he had in mind. As for why he had it in mind, I think that he was already thinking about the fact that a frozen supply of base money, or to use terminology that's more appropriate for Bitcoin, first layer exchange media, is would itself not be all that satisfactory, that there are advantages to be had, considerable advantages to be had from a second layer technology. And banking was simply the most basic second layer monetary technology out there. It's tried and true. At least it works well if the regime is properly regulated or not over-regulated with dumb regulations. So I think it was just natural for Hal to be thinking about doing better than just having an exchange system, a monetary system relying 100% on Bitcoin. He was thinking about the second layer. Today, we think about things like Lightning as a second layer technology, and of course, there are other alternatives. But banking is still a feasible and perhaps the simplest alternative to contemplate to provide close substitutes for Bitcoin that are denominated in Bitcoin. So they're still part of a Bitcoin standard, but they have certain advantages for both being a more elastic component of the money supply and having lower transmission costs because it's not expensive to move units of bank money around electronically, uh, and it is less costly. It's obviously less costly than gold coins, but it also has advantages over actual Bitcoin in terms of the costs of transacting and scalability and that sort of thing.
So when we talk about free banking, what exactly is it? Because currently we have a
Yeah.
Fed, and then we
Yes.
have banks underneath it. Banks
Hmm.
can create money um, in the form of credit.
Mhm.
So, what exactly is free banking? What is so innovative about free banking?
Well, the way you ask the question, Andrew, is a good way because it points to the fact that what free banking is depends on what the base money regime is. So we can talk about three possibilities. What is free banking with the Fed and the dollar as it stands? What is free banking with, say, gold or silver, which would be what it was in the past? And finally, what is free banking with Bitcoin? Right? These are all different possible free banking regimes. And you're quite correct. Free banking based on the Federal Reserve base dollars would be less radically different from what we have today than either of those other two things, but it still would be different from the current status quo. And it would be different because under free banking, you don't have as many regulations. You have only the most basic regulations imposed on banks. One of the differences would be that banks would not be restricted to providing deposits. They could provide competitively, they could provide paper banknotes, which would be more old-fashioned, but they could
What does
also
that mean
provide
exactly?
tokens.
Banks will
What's that?
not be, what does that mean exactly? Banks will not be restricted to
To,
provide deposits.
Today, the only kind of bank money, bank supplied money that banks are allowed to issue in most countries, there's still a couple exceptions out there, consist of deposits. That is, deposit credits, which you can move around electronically with a debit card or in some by check still, and some other ways. But what distinguishes those from any currency is that they don't pass from hand to hand. That is, people who don't have bank accounts, uh, they can't hold them. You have to have an account with a bank. So it's not now in the old days, competitive banks issued circulating IOUs, they paper money. And of course now those are only supplied, paper money is only supplied for the most part by central banks. So in a true free banking system, banks could offer circulating media, not just banknotes, but today they could offer tokens, right? They could offer stable coins. Stable coins would be a feature of a free banking system, probably. There are other important features, but generally it boils down to this, that in a free banking system you don't have a very complex set of regulations. You also don't have deposit insurance and other guarantees that are part of almost all actual banking systems today. So the the expression free banking should be taken literally as banking that's free of special regulations. Banks have to honor their contracts, of course, and they should be closed down if they don't. Uh, but otherwise, the government neither props them up through bailouts and insurance, nor hampers them with artificial limits on their activities. So that's free banking. If we go to the gold standard case, free banking starts to mean something very different. It has more radical implications because in the gold standard, of course, gold itself is the monetary base medium. So allowing banks to issue notes and otherwise deal in gold and free from all kinds of binding restrictions uh, is an alternative in that case to having any kind of central bank. Because the way we got central banks and ultimately got fiat money was first by having a gold standard or silver standard, giving one bank a monopoly of paper currency, right? And then once that bank had a monopoly, this is the original early central banks. Once we gave a central bank a monopoly, which was already a big departure from free banking, a monopoly of paper currency, then one day that central bank stopped redeeming its currency in gold or silver, and at that point it became a fiat money issuing central bank, and its paper money and deposits became base money in place of gold. So, so now the difference, so free banking is can be both an alternative to central banking, if you think about it in a non-fiat money context, or it can be part of a fiat money system where the fiat money is the base on which you build freedom of banking. So it's a little bit, it's subtle, but it's important to recognize that you can have free banking with a central bank that supplies fiat-based money, but you can also have a free banking system that doesn't involve a central bank if the monetary base, is itself something that it doesn't require a central bank to supply it, which would be gold and also Bitcoin. So if we had a Bitcoin free banking system, it would be more like a gold free banking system than like a
Mm.
fiat free banking system. I hope that helps.
No, it makes sense. So what you're saying is you have many different banks.
Hmm.
They have gold reserves and they issue, at least this is how they used to do it maybe in your book. They have gold reserves and they issue fiat currency.
No, no,
No.
no. Fiat currency is irredeemable paper currency that is almost uniquely associated with a monopoly central bank that can do that. In the gold standard days, when ordinary banks, whether they're free or not, but especially free banks, they're issuing paper currency that is redeemable in gold. So you can go up to a bank with its banknotes. Like, let's talk about the Bank of Scotland. Right? Scotland had a free banking system more or less before 1845. You could go to the Bank of Scotland with its notes, at, say a 10-pound Bank of Scotland note, and you would get the gold to which that entitles you. Fiat money is a whole different thing because you can't go to the Fed and get anything for your $10 Federal Reserve note except maybe two fives, right? Or,
Yeah.
or a fresh note.
A
So
coin.
fiat money is an inconvertible money, whereas the paper currencies that were issued by banks in the past, commercial banks, and especially by free banks, which had always had that right, they were redeemable claims to gold. And in the same, they were very much like stable coins, the better stable coins today. With a stable coin, a dollar stable coin, you can get a real Federal Reserve dollar for it. Now, that's only true for some of the really good ones. A lot of them, in practice, we have to realize that stable coin issuers, many of them don't make it very easy for you to redeem, especially small amounts of stable coins. But in principle, in a truly competitive system, you would see redemption arrangements with stable coins that kind of look like the old banknote redemption systems.
So what you're talking about is basically what America had pre 1971.
No, because we
No.
still had a fiat dollar before 71.
You could
Remember,
redeem it though, no? As in,
no,
like, in the
no.
beginning, you could redeem it for some gold, and then that started to become half the amount of gold, and then it became a
Now, what
fraction.
the Americans lost their right to convert any kind of paper money into gold in 1933, back in 1933. Now, what remained the case afterwards, after devaluation, which you alluded to, is that indirectly foreign central banks could get gold for their dollars. But the ordinary American citizen could not. In fact, until 1976, it was illegal for American citizens to own any sort of monetary gold. So we certainly didn't have a true gold standard of any sort after 1933.
Wow. Okay, I
But,
didn't know that.
yeah, and between the founding of the Fed in 1912 and that suspension of the gold standard in 33, we also had been moving steadily towards the Fed having a monopoly of paper currency, and all other banks were gradually losing any rights that they had to issue paper currency. They'd already had their rights restricted substantially before 19 but 19, I said 1912, 1914, before 1914 when the Fed was founded. Um, the A true free banking never existed in the United States. Nothing. There were pseudo free banking systems before the Civil War. They were called free banking systems, but apart from the name, they had a lot of regulation. You have to look to other countries for past examples that approximated free banking as I and other free banking theorists understand it. Scotland, I mentioned, that was one. Canada was another. All of these were approximate. They all involved, some departures from the ideal, but they were certainly closer than anything the United States ever had. And they all worked pretty well. They were all pretty stable, and that's what Hal is referring to when he talks about the stability of free banking. He's not just referring to my theory. There are empirical examples that testify to that stability.
So when you say your theory, your book, when was it published, and what theory? So the theory is basically you're just saying that, listen, in the past, this is what they did, so maybe this is what we should do now.
Well, we have to separate the analysis from any, the policy prescription. A lot of people assume that, that the book was calling for a recreation of past style free banking systems, but mostly was just explaining how they work and showing indeed that they could work pretty well. And the policy implications that come from that, well, it depends on how far you think you can go. It is very difficult in practice to recreate a system like the Scottish system of today. But anyway, the book that Hal is talking about is my first book, which was called The Theory of Free Banking. It was based on my university dissertation, my PhD dissertation. So I actually wrote it around 1985, 1986. Took a couple years to actually get it in print. Title suggests it is a theoretical work. Now, it's not based on any one past banking system. Instead, uh, I draw on a number of case studies to arrive at a sort of general free banking, ideal free banking system. And I describe what that ideal consists of. And what I'm trying to do, what I'm asking in doing that is, what would a banking and currency system have looked like if there were no government interference other than the enforcement of contracts? So I'm drawing clues from these past examples, Scotland, Canada, and others, but I'm also trying to find out what were their features that were due to free competition and free market forces, and separate out from those some other features that those systems had that were really a result of special regulations. So I'm trying to come up with an ideal, pristine free banking system to talk about, and then I theorize about that system, that ideal.
Okay, so realistically, what are the benefits associated with free banking in theory versus what
Right.
we have today?
Well, a free banking system, first of all, would be more robustly resistant to panics for all kinds of reasons. Uh, Today, the biggest difference would be that we wouldn't have the you wouldn't have the tendency that unfortunately has become very serious in many places for banks to take excessive risks because they expect to be bailed out. And that moral hazard problem, as economists call it, associated with the expectation of guarantees, is a very serious problem now. And of course, it wasn't in the past when the government wasn't even implicitly backing up free banks. It let them fail. There was no organization in these systems, no government organization that was going to rescue a bank that took excessive risks. But there are other advantages as well. The, a lot of them have to do with the greater flexibility of the money supply. If you allow banks to issue currency, first of all, then they can easily accommodate changes in the form of money the public wants, right? Whether they want deposits or circulating money. And they can do that without it causing instability. Whereas if you have a central bank that's the only source of currency, unless it is on top of things and always gets the supply of currency correct, what can happen, or if you have other regulations that restrict ordinary banks' ability to issue currency and you don't have a central bank that does it, then you can get situations where when people want circulating money and they can't have banknotes or equivalent, right, or stable coins, they start to withdraw the base money reserves from the system to use. And that can be a cause of a very serious contraction of the total money supply because every dollar of reserves is supporting several dollars of deposits and other kinds of bank money. So we had a lot of historical instability in banking systems was due to, and this was true especially in the United States, was due to artificial limitations on ordinary banks' ability to issue circulating money. A huge problem. It was, in fact, the main problem that led to the establishment of the Fed. But they could have solved it, and they talked about solving it. Many people proposed solving it by just letting the banks be more free to issue their own circulating media. In Canada, where they still had relatively free banking until 1935, they didn't have any of the crises that we had in the United States because the banks were more flexible and able to accommodate changing public needs. Another thing closely related to this that I spend a lot of time trying to demonstrate in the book is that it's also the case that even if you have a fixed supply of reserves in a free banking system, the total supply of bank money can grow over time to accommodate the public's needs. It's obviously important, if that's going to happen, to not have rigid reserve requirements that are imposed on the system, because then, of course, you can't have growth of the money supply without growth in reserves. And this too was a feature of past banking system, and I think it's what Hal has in mind. It creates scalability, which wouldn't be there otherwise.
Yeah, so you're talking about fractional reserve banking here, no?
Yes, this is
So,
all fractional reserves.
so
That's
you
right. Free
have
banking's all
you
fractional
have
reserves.
fractional reserve banking in free banking as well, in the free banking
Oh,
model as well.
yeah, and how? And how? You know, the reserve ratios of the Scottish and Canadian systems were very, very low. Even as early as the 1830s in Scotland, the gold reserve ratio gold or silver because it depend it, it which of those metals was really important. It was mostly gold by then, and but the gold reserve ratios were often less than 2% of the bank's liabilities. So they were very slim. And yet we're talking about some of the banks that were considered the most stable in the world. The banking system very safe. So one of the odd things about free banking or interesting things about it is that it is based on fractional reserves and it can be based on very slim fractional reserves because the way the system operates gives it flexibility and allows it to build confidence in its bank money in a way that's not possible in other systems.
Why? Because you have Bank A who's doing a fractional reserve of 2%. You have Bank B which is doing a fractional reserve of 10%. So it's up to the individual maybe to choose the
No,
correct bank.
well, not that way though. Most people in Scotland had no idea exactly what reserves their banks were holding. What they knew or what they needed to know was when they asked for their gold, was it did the bank pay? But actually, more important than public requests being met was the fact that in all these systems you had a constant daily interbank exchange of IOUs. So the banks were constantly testing each other. The banks were very jealous of their share of the market for money. And so they would get their hands on notes as well as other items, checks from other banks, and they would send them through established clearing systems, private market clearing and settlement systems. And those systems were what disciplined the banks, because if you didn't settle up at the end of the day in your clearing, what your net clearing obligations with reserves, you failed. You were a failed bank, and your reputation was over. So the active interbank exchange of competitively issued currencies was what was disciplining these systems and what ultimately contributed to their good reputations and allowed them to get away with not having reserves, because a very small amount of reserves could be adequate for those interbank net settlements because you're netting out all of the transactions across banks.
So you owe me 10 million, I owe you 9 million, so we just have
I
to prove the 1
That's
million.
right. That's right. And if you do that for a whole bunch of banks together, the opportunities for netting are even greater. So what can happen though in that kind of system is uh, the ability of the banks to increase the ratio of total money out that they're able to keep in circulation to the quantity of reserves in the system is a function of how of the people's demand to hold on to money. So to think of an extreme case, suppose you have a banking system, a free banking system where uh, people suddenly decide they're not going to write any checks and they're not going to make any payments. That's an extreme case. The banks could expand because nothing would come back to them, right? As long as the money goes out and doesn't come back, they can keep expanding. Well, in reality, of course, money is coming back, but the greater the public's demand to keep on hand a certain amount of money, the more the system can scale up. And so, in theory, you have an arrangement where there's no limit to the potential long-run scalability of the system. A small amount of reserves could, over time, become adequate to support a much higher supply of bank money. And this gets back to Hal Finney, because I think that's the main thing he was concerned with, that you wouldn't have this limit of 21 million bitcoins was not going to prevent the total Bitcoin money supply from growing and scaling as much as necessary if a free banking system was able to build a superstructure of its own substitutes on
Makes
that
sense though.
fixed base.
It does
That
make
was the thing.
sense.
Yeah.
It does make sense, no?
Yes, I think it makes perfect sense. But I mean, it makes sense in that what Hal was saying, and I agree with him, is that there's no reason that for a Bitcoin banking system to not be able to do what a gold-free banking system did in the past. No
Exactly.
reason at all. And so, and and I should add that some people say, well, in the past, the only reason people would hold a Scottish banknote instead of a gold coin was because coins are clumsy and you put a hole in your pocket, and who wants to transact with them? And it's not, you obviously aren't able to just do electronic transfers. Therefore, some people conclude there wouldn't be any motivation for banking with Bitcoin, where moving a Bitcoin around is relatively costless, relatively. But first of all, it's not that costless. We know that first layer transacting in Bitcoin isn't always cheap, uh, though it's cheaper than using gold and more convenient. But you have to also consider that there's interest involved, because with fractional reserve banking, right, only part of the bank money is backed by actual reserves, whether it's Bitcoin or gold. The rest is backed by loans and other interest earning assets. So the interest the banks are earning, that comes back to the holders of their money. They either get some actual interest, a share of the interest that the bank earns
Who gets the
the
interest?
people who hold the deposits, and sometimes the people who
Like
hold
a
other
savings
kinds.
account, basically.
Yeah, well, or like a demand deposit, at least those can also earn some interest, and sometimes do, depending on circumstances. But the other thing that they get is this free accounting services, which is worth a lot. Your bank is doing a lot of nice stuff for you you can keep track of how much you spend and all. That costs money too. But most of us don't have to pay much for that service, and that's because we're helping the banks earn interest that can cover the costs. So banking would still be, and bank money, Bitcoin banks and their money would still be attractive alternatives in a Bitcoin standard, compared to using Bitcoin itself, and they could be competitive with things like Lightning as well.
Okay, so in your opinion, could a Bitcoin-based free banking system work in practice today?
Well,
And how
there's,
might it work?
let me put it this way. If if the public really wanted to switch to Bitcoin, right, to a Bitcoin standard, then of course, then a Bitcoin standard with Bitcoin banks, I think could work pretty well. I should say, Andrew, I didn't point this out, but in my book, even though I draw on historical cases of gold standards and other things where the supply of base money could grow, in the theoretical parts of my book, I assume a fixed supply of base money.
So you were talking about Bitcoin indirectly.
Well, you could say I was talking about a system that resembled a Bitcoin banking system in that the supply of base money was not able to grow. I took that for granted. And it was in that context that I showed how the thing could scale as the demand for money grew. So, so obviously, I think that in theory, if you had a Bitcoin standard, then that standard with a banking system could work pretty well and could produce a, pretty decent macroeconomic stability. Now, that's assuming that the public is always happy to hold, Bitcoin bank money. In Obviously, if the public didn't want to, if the public could in principle, run on the Bitcoin banks or decide it doesn't like their money anymore, you could still have panics. Now, there are all kinds of ways, as I suggested before, why a good free banking Bitcoin system would be less exposed to panics than some modern banking systems are. But it wouldn't be, you couldn't rule it out completely. There are things you could do to prevent panic from causing too much trouble. But you can't say it's not possible for people to come and try to take all their money out. That would still be possible. But it would be a workable system. The the other but the other side of this is, of course, we don't have a Bitcoin standard, and you're not going to get Bitcoin banking until Bitcoin becomes a really popular exchange medium, because nobody's going to set up banks uh, to create substitutes for a Bitcoin, transactable substitutes for Bitcoin, unless there's a demand for such substitutes. And those substitutes, you don't get a demand for bank money substitutes, Bitcoin bank money, out of the now very important investment demand for Bitcoin, right? That isn't going to give you a basis for a Bitcoin bank entrepreneur to get his business going. You have to have a demand for Bitcoin as a medium of exchange that's going to be used a lot for payments before you can grow a Bitcoin free banking system. Uh,
Okay,
uh,
so what you're saying is that we're still very early to put so much pressure on Bitcoin to handle such a task.
yes, yeah, I mean, I think if Bitcoin becomes more popular as a medium of exchange, then that will also make Bitcoin banking viable. And that will in turn make Bitcoin a better medium of exchange. So there's a lot of ifs going on here,
Yeah.
right? Because but if to the extent that Bitcoin is only popular or mostly popular as a longer run investment medium, then that popularity alone, it can make Bitcoin's price go up, of course, but it won't generate much of a demand for Bitcoin banks and won't necessarily make them viable.
So
Because
does it make sense that banks accumulate Bitcoin now, whilst it's relatively unpopular or relatively cheap, let's say? Maybe it's not cheap, but they accumulate it now, so that in 4 years' time, in I don't know how many years' time, they can roll this out and issue stable coins on top of that. So like you can get a loan from the bank, and it's, let's say, the stable coin is backed by Bitcoin reserve, But if you want, I don't know, the Bitcoin back, you cannot get the Bitcoin. You get stable coin, or you get an interest on the fact that you're using that bank stable coin. Am I
Well,
mixing it up,
yeah.
or
Well, it you wouldn't you have the question is whether it would be viable for somebody to set up a business. So what is this business offering to its customers? It sounds like you're describing an exchange, right? We have exchanges now. You can keep your Bitcoin with them, subject to some risk, of course. You're not getting substitutes that you can spend for those Bitcoin. So it's not Bitcoin banking. Uh, you are getting storage services essentially, right? You're getting a storage service. And, so one way to think about your question is whether Bitcoin exchanges might morph into Bitcoin banks or go into the Bitcoin banking business. And that's perfectly possible, but I don't think it rules out the fact that I don't think we can rule out their doing so if the demand is there for Bitcoin, transactable Bitcoin substitutes. That can very well happen. It's a little analogous to the story people tell about the beginnings of gold-based banking, right? Where this story, I've actually criticized it because it's not exactly true, but the story that's told is that you started with warehousing operations, with the earliest proto banks in the days of let's say, the 16th, 17th century, early 17th century. They were just storing money, right, for customers and giving them accounts and keeping track.
are
But
you
they
talking
weren't.
about the Medici banks?
No, this is more like the goldsmith banks of England, where they were storing up the gold and supposedly acting like warehouses only. And then eventually went into creating substitutes for gold that could themselves serve in exchange, right? Be passed around hand to hand, etc. So in that story, you have something analogous to what would happen if today's Bitcoin exchanges got into the true, Bitcoin banking as I've and as Hal and I have contemplated the possibility. So that's what that is certainly something that could happen. But it all depends on there being a market for these Bitcoin substitutes that serve as a medium of exchange. And that's going to take time if it happens.
Okay.
But I mean, the significance of all this is that we have a very easy way to deal with the scalability problem if we if it you know if it becomes a question of wanting to have a monetary system that only has 21 million, a Bitcoin based monetary system that only has 21 million or fewer Bitcoins to deal with. Can we solve the scalability problem? Yes, we can. Banks could do it, and therefore it's feasible. And that's, I think, already an important thing, independently of whether this is going to happen and when it might happen.
So you don't think Lightning has solved that?
Not exactly. It's not as cheap as banking can be. You can think about, I live in Europe now where they do these things a lot, and so do you. They do these things a lot better than they do in the United States. It's very cheap to move ordinary bank money around. You hold your phone up and it doesn't cost, there's no transaction cost to speak of. It's trivial. And so that's how cheap it could be to move Bitcoin around with a Bitcoin banking system.
The thing is, I find that it's become really difficult to save fiat. So um, I guess my question is, so Bitcoin is a money of trust. No, we trust
Yeah,
it has 21 million. We understand its background. We know its issuance.
yes.
So isn't it logical that we move away from something that you can print, over and over into something which is more trustful and benefit from whatever comes out of that?
I think I've written and argued about this a lot, and people don't, Bitcoin fans don't like it when I say it. But the big problem is that money is a network good. And so,
A network good,
even, yes,
which mean
network good. What that means is that the attractiveness of any medium of exchange is a function of how many people are already using it. Uh, it's kind of like joining imagine a telephone network, right? Suppose we're at the beginning, suppose we have you're thinking of buying a telephone, and you have different networks out there where there's some where there's a whole lot of people you can connect to, and others where there's so far only a few. Even if the even if the one with few people connected is technologically superior, you might still go for the bigger network because you want to make sure you can call more people.
yeah,
Okay?
like WhatsApp, for example. Everyone's on
Yeah.
WhatsApp. Yeah.
Everyone's on WhatsApp now, and WhatsApp, of course, piggybacks off established networks, so that's a special case. But when we're talking about Bitcoin versus fiat, we have incompatible networks. In other words, if you choose to use Bitcoin as your medium of exchange, you want to rely on that. It's not the case that every place that you can buy stuff with dollars or with euros is also a place where you can use Bitcoin. Now, there are technologies that allow you at relatively low cost to do it, what is really an exchange transaction, right? So uh, you're really paying the merchant with Bitcoin, sorry, with the established national currency, but you're using a program to do a quick swap. It's very much like a foreign exchange transaction. If I go on Amazon US, Amazon.com, I can buy stuff using my
Euros.
Spanish bank credit card or debit card. I'm not really paying the Amazon merchants with euros, of course. There's a foreign exchange transaction involved. And in the same way, now it's getting easier and easier to use your Bitcoin to pay merchants who don't actually accept Bitcoin with an exchange transaction. So that helps, but it doesn't quite get around the network problem, which is the problem that ultimately we need dollars for those merchants, and the dollar isn't going to go away if we're just using Bitcoin indirectly. So the attractiveness of Bitcoin is limited still by the size of its network of acceptors. And that network is small, certainly compared to the dollar network or the euro network. And so that's what those network economies give an advantage to the incumbent established currencies and present Bitcoin with an uphill fight to gain popularity. So that's one problem. It's not insuperable, but it can take some. It can it can start very slowly, and then of course,
Yeah.
the more people who join, the more rapid the change can proceed.
I mean, it's 16 years old.
Yeah, it's not.
It's
It's
still
still
young,
young.
no? It's
Yeah,
like
that's
so
right.
yeah.
That's
So
right.
in your opinion, what would confirm then that the network is big enough?
Well, I don't know if it's quite a question of confirming it. The bigger the network gets, the more likely it'll continue to grow. I couldn't give you a number of, how big it has to get before banking becomes attractive. But there's another problem that has to be faced, which is, and this is the irony, is as long as we don't have, Bitcoin banks and substitutes, um, suffers in its capacity to grow as a monetary medium by the fact that it is a popular investment medium. So what do I mean? I mean, to put it in very basic terms, the greater the expected rate of return on Bitcoin, the less people want to spend it. And the less they want to spend it, the less useful it is or less used it is as a medium of exchange. And if it's not used as a medium of exchange, that in turn feeds into the lowered prospects of Bitcoin banks being established because there's not enough need. And that, of course, means that Bitcoin will appreciate more rather than less because there are no cheap substitutes for it that people use instead. So there's a kind of irony in the fact that the very thing that is really what Bitcoin has been most successful at, which is providing a medium, a new investment medium that has proven very lucrative for many people, unfortunately also undermines its prospects for becoming money because you can't hodl something and spend it at the same time and use it as money at the same time.
Then what did they do with gold?
Hmm.
So like,
What? Hmm.
isn't that the same? So didn't I hold a bar of gold um, for that same reason because it's going to appreciate over time?
Well, you might
And
have,
and
and
use silver as a, and actually
yeah,
use silver as a medium of exchange.
gold did tend to appreciate over time, but not that much, not that much. Yeah, and one reason for this is it has an elastic supply. So what happens with gold is it'll appreciate for a while, but then it becomes profitable to mine more of it. And so if you look at the actual real value of gold over the very long history, right? It tended under the gold standard, the value of gold didn't go up that much. In the long run, it tended to be fairly stable. Gold has gone up a lot since it has ceased to be money, but it didn't appreciate the way it has in the fiat money era. It didn't appreciate for long like that before. So it actually fits the story where, yes, gold could serve as a monetary medium as long as it didn't depreciate too much. But once it did start, but it only started to appreciate a lot after it was no longer a monetary medium, and that in turn would make it less attractive for people to try to establish it as a monetary medium again. But we don't see in history, we don't see successful monetary media that ultimately come to attract banking business built on that medium that also appreciates, you know, a lot. We don't see that. We don't see that. It's a bit of a hat trick to have something that serves as your monetary standard and also has got a high rate of return, more than 1 or 2%. That's a tough combination to make work in practice.
So is it fair to describe Bitcoin as a completely new monetary framework? So it has no ties to Keynesian school of thought, and it actually has no ties to Austrian school of thought. It's just a
Well,
new digital asset, basically. And we
well, I
don't
think
really
it
know
I
what it
think it
is.
is I think it's a new kind of asset for sure, and I've talked about it, but I wouldn't say that its newness makes it uh, no longer compatible with Austrian economics or with Keynesian economics for that matter. I think Keynesians could theorize about Bitcoin if they wanted to, and I think
Really?
Austrians can. Yeah, they might get it wrong, but I don't think that an economic framework can be right or wrong, of course. It can get things right or wrong, but I don't think that having a new asset requires having a different economic framework. Maybe let me put this one other way. Let's suppose we had an economic school of thought that was right about everything so far, right? And now Bitcoin comes along. Do I think we would have to revise economic theory tremendously from what that school of thought had developed in order to accommodate or deal with Bitcoin? My answer would be no. I think we would learn some new things, but you wouldn't have to overhaul the theory completely. I can tell you exactly with respect to the Austrian economics, where I think some overhauling has been necessary, but it hasn't been all encompassing. Let me step back first and say that back in 2012, I published a paper, which I actually wrote in late 2010, uh, called
Then was your year.
Synthetic Commodity Money. and I classified Bitcoin. I didn't say Bitcoin was a synthetic commodity money. I said it would be if it were money, right? If
It's a
it grew
synthetic
into
gold.
commodity money, synthetic commodity money. What synthetic commodity money is this? It's, well, let's step back. Until Bitcoin, there were basically two kinds of monetary standards. A commodity money standard, so your ultimate money is gold or silver or something that is a commodity that has some commodity value. It's naturally scarce. Doesn't mean you can't find more of it or maybe even make more of it, but it does mean it's costly to do so at the margin. And then you had fiat money, where, of course, the only scarcity is a contrived scarcity where you have to trust people to not create too much of it, but they could, and sometimes they do.
They could
So,
what? Trust them?
what's that?
They
You
could
have to
what? They
you
could, because you
the
said they could
a
trust them.
fiat money system is one where some authorities could always augment the supply, could always increase it. The stuff, it costs a lot less to produce than its nominal value, and the only way to maintain that is to resist the temptation to keep printing more of it, right?
Which they
That's,
don't.
well, they do to some extent. They do to some extent, except in cases where you have hyperinflation and the whole thing falls apart. But obviously, that's not happening everywhere. But it could. It's fiat money always, you always had the potential for overexpansion of the stuff that makes it eventually worth no more than the paper it's printed on. So that's the difference, the obvious difference between fiat and commodity money. The 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 what synthetic commodity money is something where it is inevitably scarce. There's a scarcity built into it that no authority is able to change. But it's not a natural commodity. That's Bitcoin. That's synthetic commodity. And what's interesting about it is that in theory, you can design a synthetic commodity that has really good macroeconomic properties if you wanted it to be. Now, under the right circumstances, Bitcoin itself, with its fixed supply, ultimate supply, could do that, but we have to hook it up with a good second layer technology, right? But if we could, then it could be pretty good. Anyway, so what I'm saying, Andrew, is I agree with you that Bitcoin is a new kind of monetary regime, unlike anything in the past, or potential monetary regime because its moneyness is not yet fully established. It's a new regime, but does that mean that Austrian economists, for example, have to go back to the drawing board with their theories and all? Well, a little bit, a little bit.
What would Von
One,
Mises say to Bitcoin?
yeah, what von Mises, I'm guessing, would like me have to revise his beliefs. Mises thought that the only way you can have something that is not itself a valuable commodity command purchasing power as a medium of exchange is if it was at least at one time in the past connected to a commodity. So Mises would argue that the reason we value Federal Reserve dollars and euros today is because if you go back far enough, these were IOUs to gold or silver, and therefore their value was tied at one point in the past to their commodity value. They had a value independently of their monetary value. And that allowed expectations to develop that made it people willing to hold on to these things, and as it were, help launch them into the use as money. According to that theorem, which is called the regression theorem, uh, nothing could become money, become valued, uh, that isn't itself a commodity without having at one point been, a reliable IOU to some commodity. Oh, well, that's out the window. Bitcoin has not only got a value, it's had a value that has gone up and up and up with, of course, some setbacks. And yet It's not a useful commodity. It has no commodity use in the sense that, you can't wear it as jewelry. You can't, it doesn't have any of the applications that other commodities have, any non-financial application. Uh, and it's not an IOU to something that has it. It's not even a claim to an existing fiat money. So the regression theorem seems to not allow for it. And so we have to go back and consider whether, in fact, that theorem is overly restrictive.
So the definition of what Bitcoin is its main hurdle point, if I'm understanding, because like when you say it's not natural, isn't the process of mining extremely natural? Like, if you have to, for example, go and mine Bitcoin in Malta, you're not gonna make any profit because it's hot. You have a lot of things. You have to expensive electricity. If you go to Paraguay, or I think Paraguay is the one, it's apparently you're tapping into their hydroelectricity. So, for
Well,
example, if
yeah,
you're in Africa, you can have a power plant, and the main power plant is mining BTC. Isn't that a form of natural, like,
yeah, but
physicalness to it?
I'm not, yeah, but what makes Bitcoin a synthetic commodity isn't the fact that the ordinary profit and loss considerations aren't going into how it's mined. It's the fact that all of this ultimately rests on an algorithm that some people figured out, and it isn't just that there's so much gold in the ground and not in every place and so on. So there's the artificial part, of course, is the part that determines uh, how the money how how costly it is to mine Bitcoin and how difficult the problem is that has to be solved in the algorithm. All that stuff is obviously artificial. That's what I mean by not natural.
Okay.
But once you set up the algorithm, then it starts to look a lot like gold mining, right? And you've got to put resources into it. In some places, it's cheaper to do the mining than in others because of the cost of electricity and so on. So all those things do resemble what's true of natural commodities. But in the end, if I can speak very loosely, right, with gold, God put so much gold in the ground, hid it here and there, and then that's the algorithm that's going to determine
Exactly.
mining profitability.
Exactly.
In this case, we have something that is obviously a human innovation, a human invention, and in that sense, not natural. That is the determining what when it's profitable and where to mine Bitcoin.
Yeah. So how would you so okay so how would you classify Bitcoin economically speaking? Like, is it money? Is it an asset? Is it property? Is it a protocol? Like, what exactly in your mind? How should it be defined?
Well, it's several of those things. It is
Hybrid.
it's certainly a financial asset, but it also refers to the protocol or algorithm that determines how the quantity of the asset can grow, the nominal quantity. Finally, and this is where I get into a lot of trouble, but it is it is a medium of exchange. It is used as a medium of exchange. Whether it qualifies as money or not depends on how generally accepted you think it has to be before it fits that description. It certainly would qualify as money. I'm pretty sure it qualifies as money in places like Bitcoin Beach and other Bitcoin resorts. Outside of those special circumstances, I don't think it would fit the description of money, but at least not in any geographically defined economy. And I think for the vast majority of people, they have to admit, even if they're Bitcoin fanatics, that if they only shopped using Bitcoin, they would be restricting their shopping opportunities to some significant extent compared to using official exchange media. So, so Bitcoin is a lot of things, but it is in most places. Money isn't one of those things in most contexts.
Interesting. Um, so
Yet.
I have a few, just a few more questions.
Okay.
What do you think of digital silver? Like, would gold have survived on its own without silver? And in your opinion, is everyone just putting all their efforts into BTC but forgetting that there are other, let's say, proof of work coins that can replicate the silver element in all of this? And then it
I
becomes
really,
money
yeah,
because it has something to like compare against, and it's also free. And I'm referring to Litecoin here, for example.
yeah. I don't know. These things are, first of all, on gold, I don't see the sense in which gold depended on silver. Historically, as money, you could say it depended on it in the sense that silver served as a supplementary money for smaller transactions, but often silver was the standard money and gold was not. But the harder question is what makes the question hard is this whole idea of surviving. I don't know how gold wouldn't survive in some fashion. Obviously, it hasn't survived as money for the most part, and it's important for people to realize gold isn't money anymore for the same reason that Bitcoin isn't. The number of places where you can transact in gold has become very routinely and easily has become very small. There actually are a few places, I'm told, in parts of Venezuela, for example. But outside of that, you'd be hard pressed to use your gold as something to shop with. Um, but on other cryptocurrencies, it's an interesting question. I don't know why they haven't taken off in the way Bitcoin has. But I can only say that Bitcoin has taken off mainly as an investment medium, and it has managed to gain a reputation for being a good investment. And those other things have not done it. But this is getting into the world of investment and speculation where I, as an economist, don't have any valuable insights to offer. That's why I'm not rich. I'm doing okay. Don't worry about me, but I don't pretend to have any special insights. But obviously, Bitcoin is not the only potential a synthetic commodity money, and it's not out there, and there can be more. But it is the case that it is by far, got the lion's share of attention and support. And just why these others haven't taken off is something that I can't really explain.
Okay, so I have my last question, and it's basically just like if Hal Finney were alive today, do you think he would say what do you think he would say about Bitcoin's evolution to date? And do you think he
Oh
would
goodness.
still suggest what he did in 2010?
Well, well, if I if I'm not a good investment guru, and I have no insights into why some commodities are more attractive than others for investment purposes, I certainly am not able to channel Hal Finney, with whom, as I said, I never hardly had any exchanges with. I was not a close friend of his, so I couldn't even draw on my knowledge of him to speculate. But I can say that I don't think things have changed very much since he wrote that bit about free banking and on online. I think he would certainly not see Bitcoin's success so far as ruling out its becoming what he was looking forward to it becoming back in 2010. I think that he would still see a role for Bitcoin banks because nothing has changed to make that, their potential contribution any smaller than it would have been then. Lightning might, of course, and things like that might have him thinking that yes, there are other ways to have good second layer and scaling. But so far, they haven't, I think, I don't think we have good reason to think that banks would have no role to play in a Bitcoin standard commodity. That's about as far as I can dare go in saying what I think Hal would be saying. I think he'd still be bullish on Bitcoin, not just in the investment sense, but in the sense of it's ultimately playing a more important exchange role. And I do want to say also that for myself, even if I say that Bitcoin isn't money in many places yet, according to the standard definition, that doesn't mean that it's not a very important medium of exchange in certain contexts for certain kinds of transacting and moving money around, especially when it's necessary to not have government snooping on you or interfering with your ability to move wealth around. Bitcoin is extremely important. And if it never caught on for transacting in general, if we never had a Bitcoin standard, it would be worth having just for those reasons. So I say this because people are, some people in the Bitcoin community are much too quick to draw the conclusion that just because I say it's not a widely accepted medium of exchange, I'm anti-Bitcoin. I'm
No,
actually pro-Bitcoin. I'm pro-Bitcoin for what it is already doing, and if it manages to do more, I'm for that as well.
really nice. I think it will get to be a medium of exchange when his 10 million a coin, if it
You
ever
mean you
materializes.
mean a generally accepted medium of
A
exchange?
generally accepted medium of
Yeah,
exchange
yeah.
because if I mean it goes to astronomical numbers, um, then like you can spend it kind of thing, and it can be denominated no 100 sats to $1, and it might become quite easy.
Well, it all depends on whether if it goes that high, whether whether people will think it's going to go even higher, right? And so then they'll keep hodling it if
Well,
they do.
maybe it is like a money for the next, I don't know, 100, 200. I mean, 100 years it should be if it's going to replicate fiat, but maybe 500 to 1,000. Because in that case, then we are a bit we're not really important this next two, three, 4 generations if it's going to serve the future.
Well, I don't think it's going away, and
Yeah.
therefore it's possible.
George, this was a really nice conversation. Thank you very much.
No, you're welcome, Andrew. You're
I learned
welcome.
a lot. So thank you very much.
You're very welcome, Andrew. I enjoyed it. I enjoyed it very much.